Hi everyone, welcome to episode 17 of Learn on the Go. Now, it's been many years since lounges were introduced at airports. I first entered one in 2006, and at that time, you need to have a premium credit card or a membership or a business class or a first class ticket, like I had, company sponsored, of course, and then you could enter that lounge. And once in, you're in a peaceful place with comfortable sofas, good food, soda, beer, and a sense of exclusivity. Fast forward to today, the aspirational part is long gone. Lounges have become a lot more accessible, it's very noisy, and we are often greeted with long queues at the entrance and at the food counter. So, what has changed in the last 20 years? Well, firstly, we have a lot more people who travel by air. About 1.4 crore domestic travelers every month, according to the DGCA. Then the food is quite expensive at airports, and low cost airlines don't serve hot meals on their flights, assuming their flights are not cancelled. And of course, there is complimentary entry for most credit card holders and even some debit cards. In numbers and per a report by Frost and Sullivan, there are around 7 to 8 crore credit and debit cards in India with launch access, and by my reckoning, a crore passengers avail launch facilities every year. Which means 1 in 15 passengers are presently using the airport's launch facility, which brings me to the mukhya patra of this video, which is Dreamfolks Services Limited. This company was listed in September of 2022, and after a run up, the stock price of the company has been completely rogered from 780 rupees in July of 2023 to the 500 to 400 range all through 2024, and it's now down to 110 rupees. I'm sure you've heard of the stories, Adani, termination of contracts, banks pulling out, a failed bid to acquire Dreamfolks, etc. I'll touch upon some of these, but the real essence of this exercise is to understand platform businesses, as in why some businesses do exceptionally well while others are doomed to fail. That's why this video's thumbnail says deception. Not just this character, but deception here means how we deceive, how we fool ourselves to believe that a platform business is a perpetual monopoly with a formidable moat. In the case of Dreamfolks, it wasn't as strong as what it was meant to be, and that's what our learning quest for the day shall be built upon. Okay, let's start with Dreamfolks, which is or was, or maybe it still is, India's leading airport services aggregator that connects lounges and all kinds of airport facilities with the end users of banks, card networks, airlines, and other enterprises. So, on a skeletal level, you swipe your card at the airport lounge. Your request hits the Dreamfolks system on a real time basis. Dreamfolks would then check the card's validity and launch access availability and informs the launch operator. This happens within microseconds, and the aggregator simultaneously informs the company of the service availed by the cardholder. Overall, this is a win-win-win for clients, that is, banks, credit card companies, OTAs, airlines, the networks, Visa, MasterCard. It allows them to create custom loyalty-driven offerings such as complimentary launch access. For operators like Plaza, GVK, Araya, TFS, Encom, etc., the Dreamfolk system is a single point of access to a massive passenger base from multiple card issuers with real-time benefit validation. And for the end customers, so people like you and me, it enables hassle-free access to services. I'm putting hassle-free under apostrophes, and I'm sure you can understand why. Dreamfolks started this current financial year with 75 domestic launches. The company continues to expand globally, has diversified horizontally as well with railway launches, and has aspirations of growing its non-launch services to one-third of its total revenue within 5 years. This is a big shift, and hats off to the visionary leadership of Ms. Lebaratha Kalat, the chairman and managing director, and the rest of the team to have gotten so far. And at one point, not too long ago, the company enjoyed a 90% market share in India's domestic launch access market for debit and credit card programs, as their website still says so. Well, that's no longer the case, as the company finds itself in a tight spot, having exited the domestic airport launch services business in September of this year. As it says here, this will have a material impact, and to quantify it, 93% of revenue that Dreamfolks generated then came from the launch business. So basically 93% of the business, 93% of revenues is the impact here. It is not a bad dream, no pun intended. Okay, maybe a little, but this is the reality that the team and the shareholders of Dreamfolks find themselves in. So it's basically a game of snakes and ladders for them. They have to start from zero once again, which means a complete reconstruction of the business model, the tech, the team, the capabilities, almost everything. So let's focus on a more pressing concern, that is, if a so-called monopoly with a 90% market share could get disrupted in a matter of 8 to 9 months, then what should we as investors be wary of when examining the dozens of platform businesses that are already listed or about to be listed? I think it's a valid question, and a great place to kick this off is by examining the characteristics of a platform business. Just to draw some inferences, I'll be examining Dreamfolks along with two fairly big platform businesses, that is Eternal, Zomato, and pbfintech, which is Policybazaar. I must warn you, I might be a little all over the place, but everything will come together in some way. And that said, let's start with the first thing that almost every platform business calls itself, which is an asset light business. By definition, or rather by interpretation, asset light stands for scalability, for capital efficiency, valuation premium, and it also comes with narrative power. These may sound like buzzwords, but the deeper one goes, it becomes a lot easier to see the connections, to connect the dots. So let's spend a minute here. So scalability as a trait is essentially these 5 points: revenue growth versus expense growth, increase in EBITDA, working capital, and so on. And surprisingly, Dreamfolks has been doing poorly in all metrics, not recently, but for a few quarters now, which means the company should have been relegated in our consideration set long before this entire domestic launch fiasco happened. Okay, after scalability comes capital efficiency. Again, this is something that all platform businesses very proudly say. That is, we don't need factories to operate, all we need is brain power. But the fact is, factories or inventory or employees have now been replaced by a new set of expenses, which means the assets didn't really disappear, they just moved to new expense heads. The next characteristic often associated with platforms is that they have high valuations, which I think is nothing more than a marketing ploy. And unfortunately, that memo never reached the investors in Dreamfolks. And lastly, there's the narrative that is built to remind users, or rather investors, that the ROC will eventually explode for these platforms, and all one needs to do is to remain patient. So, how many times have you actually checked a platform business for its scalability, capital efficiency, etc.? I'll be honest here, I have not been very precise about it. And if you're on the same boat, then going forward, let's at least do a better job of this. A second term that's closely associated with a platform business is Flywheel. What is it? Well, one can call it a self-reinforcing growth loop.
अरे कहना क्या चाहते हो?
तो कहना मैं ये चाहता हूँ आसान भाषा में is that a flywheel is where every incremental action makes the next cycle a lot faster, cheaper, and more powerful. For instance, YouTube, the platform where you're watching this video, is a flywheel in the sense that more the number of viewers, more are the number of creators. More creators means even more viewers. This leads to more advertisers, more money. Even more creators join in, so even more viewers, and the flywheel starts spinning really fast. It's truly something powerful that YouTube has created for itself, but does Dreamfolk also have a flywheel? The company does talk about it in every annual report, and this is what the team there wants to convince us. However, the problem is, and actually there are quite a few problems here. So where it says add more clients, it refers to more of a business development activity rather than the existing network attracting more clients. Even when user traffic increases, it doesn't really do anything to build defensibility or to give some compounding advantage to Dreamfolks. Does it improve the economics in terms of expanding contribution margin or a decline in acquisition costs or a high return on capital invested? Unfortunately, no, because much of Dreamfolks' revenue is just a percentage of launch fees, so it's pretty linear. And finally, there is no strength here, as in it's not Dreamfolks who controls this flywheel. This is entirely in control of the launch operators or the banks and card networks who use the company services. This is very important for us to understand whenever we hear the word flywheel. And even with Policy Bazaar, I think there isn't much of a flywheel there. It's definitely better than Dreamfolks, as in when more visitors come over to the platform to take a quote or to buy a policy, it definitely attracts more insurers to come on board, which in turn attracts an even higher number of visitors on the platform. And hopefully, it improves the economics of the business. I use the word hopeful because a large part of Policy Bazaar's operations is via the call center, which is not exactly flywheel material. In that context, Zomato seems to be the closest to what a flywheel looks like, with more customers attracting more restaurants in the listing directory. More restaurants means a wider choice and discovery for consumers. All this data that Zomato actually owns is used to improve pricing, matching, logistics, and therefore reliability. This in turn reduces wastage, improving unit economics. The monetization deepens in terms of commissions, delivery fees, platform fees, ads, subscriptions, etc. And this revenue is invested back by Zomato into future growth, which is both organic and over other delivery models like Blinkit, etc. So, in my view, there is no real flywheel when it comes to Dreamfolks, and one has to be watchful of what a company says and what the operating model actually shows up. Okay, the next big characteristic that everyone does talk about is a moat or moats. There can be multiple as well, which is a good thing. And what this exactly refers to is a company's structural advantage that protects its profits and market share from competitors for a long period of time. Now, in the case of Dreamfolks, if one looks at it, they do not own any of the launches. They don't themselves offer any of those experience services. There is no brand recall. They don't issue the card. They don't know the card holder, the end user of the service. And the only real thing Dreamfolks offers is a piece of software, a cloud based technology stack that manages entitlement, validation, access, and reconciliation. Honestly, this isn't much. The technology stack can be easily replicated, and especially with big players like Adani, and not just Adani, even with big airport launch operators like TFS, Plaza, Priority Pass, all these guys are well entrenched into the Indian environment and they also have the money to spend. And that's what moved some of them in the middle of this current year to bypass the aggregator Dreamfolks and to launch their own direct to consumer launch programs. This is also called disintermediation. And the lesson here is that if you don't own something of value within the value chain, something that cannot be replaced or substituted, if your business model lacks that, then it is very likely that you'll be eventually pushed out. This simple checklist, I think, is a good way of understanding where a platform really stands in terms of disruption risk. And as you can see here, the airport launch model of Dreamfolks lacked a lot of defenses that a strong intermediary has. Pleasantly, the company seems to have learned from that, and the recent acquisition of 1011 Hospitality LLP, which actually owns and operates premium railway lounges in Chennai and has two more coming up in Mumbai and Vadodara, shows that they recognize the importance of owning the asset and the control over the business model it brings. In fact, notice the words that Ms. Kalath used: mitigate the business risks associated with third-party dependencies, which shows she has learned her lessons. I hope this video is giving you hints on how to really examine a platform business. Platform is just a word, and the way a business is constructed is what defines its strength, scalability, and durability. In fact, another way of visualizing this is in terms of who is the platform really connecting. So we have three of them, right? Dreamfolks, which connects launch operators with banks and card networks. So it's a business connecting with another business. It's a B2B model. Policy Bazaar connects millions of policyholders with some 70, 80 insurance companies. So that's a B2C model. While Zomato, that connects millions of hungry consumers with tens of thousands of restaurants all across the country, makes it a consumer to consumer, that is a C2C model. This goes back to what I've been saying all along. All platforms are not the same. And to make it even more clearer, let's do a quick comparison of some variables. The first is control. And very clearly, Dreamfolks has the least, which also means a high risk of disruption. Policy Bazaar, I would say it's moderate because insurance companies do have a say in the matter. And if the top 5, 6 insurers, ICICI, HDFC, SBI, LIC, Bajaj, if these guys were to pull out from the platform, then things won't be that easy for them. Zomato, on the other hand, has the least of these problems and exercise a lot of control over consumers by raising platform fees when they want to, and also over restaurants in terms of commissions and other services. Let's also tag this as client concentration, with a significant portion of Dreamfolks revenue tied to a few large players, which I'm sure you'll agree is a big risk. On the other hand, food delivery is one business where the absence of 10, 20, even 100 restaurants won't make a dent into Zomato's revenues. Next up is margins, and as we saw earlier, Dreamfolks has seen a steady decline, with its EBITDA margins dropping from 12% in FY23 to 7.2% in FY25. The squeeze was applied both ways by launch operators and also by the banks and card networks, which shows how precarious this platform business was for a very long time. Policy Bazaar, on its part, can do a bit of arm twisting with insurers, but not much because there are IRDA regulations and everything has to fall within the norms. However, Zomato is a different case. They have leverage over restaurants. Consumers are now habituated to pay a platform fees or opt for a Zomato Gold or whatever subscription they are offering, which offers the company almost total control over their margins. And as the latest earnings calls show, these are definitely expanding. Okay, in terms of competition, and surprisingly, while Dreamfolks and also Policy Bazaar, they have a massive market share as an aggregator, I think it would be a very narrow way of looking at it. What I mean is, with Dreamfolks, while there is no other player, it does compete with big launch operators who have the resources and the incentive to create their own tech stack, and this is exactly what is happening now. In the same way, Policy Bazaar does compete with hundreds of other brokers, lakhs of agents, and even with all the insurance companies that they are tied up with, as the insurers also have their own website, app, and other selling modules. In that context, Zomato only has a handful of competitors: Swiggy, Rapido, maybe a couple more. And for another player to come in, a new player to come in with thousands of crores worth of investments, I really don't see that happening anytime soon. Somewhere related to competition is the point on user stickiness. I did mention it a while back that we are now a lot more habituated to order from outside, which is something that we weren't doing as often, say 10, 15 years from now. But with things like subscriptions, etc., I think there is a certain stickiness to the food delivery platform. This is not the case with Policy Bazaar. And if a different agent or broker or insurance website were to offer me a better deal in terms of price or the product, then I, for one, will certainly jump ship. So again, this shows the platform is not as strong as one might have believed it to be. And please don't even get me started on Dreamfolks, which has faced the brunt of it with margin squeeze, drop in volumes, threats of disruption, and whatnot. So these are some areas I could think of very specific to the platform business. It's very easy to get deceived upon hearing the word platform, and that's what I really wanted to convey through the thumbnail of this video as well. I know there weren't any financials in this video, everything was a bit here and there, so let's do a quick recap. First up, be very careful of words like platform, asset light, flywheel, etc. Words have different meaning for different people, different companies. So always define yours before concluding anything. Okay, then how does one define it? Numerically, of course, and as an example, we saw that with scalability, which took us 5 different metrics to understand it completely. Remember, flywheels may not always fly. Like in the case of Dreamfolks, we saw a very stuttering one that the company does not control. With Policy Bazaar and Zomato, many parts of their respective flywheel were still visible. This is an important question when examining any platform business. Does every incremental user makes it a bit cheaper, faster, or value accretive for the next one? In the case of YouTube and also with Zomato, I can see this happening. Okay, when examining any platform business, ask yourself which part of its value chain is irreplaceable and exclusively belongs to it. For Dreamfolks, it's their software, which is very much replaceable. In Zomato, it's their network of delivery riders, some 5 lakh delivery riders, which is not only difficult to duplicate, but if this is removed from the value chain, then the transaction itself will most likely not happen. Okay, platforms are of different kinds, and one very effective way of looking at these is in terms of B2B, B2C, or C2C, and how the platform cuts in to create value and extract a rupee or two in the process. And finally, if you choose to ignore everything, then at least spend a minute on the margins. Any decline in margins should be carefully examined, and more often than not, there's a serious and potentially upsetting story behind it. Okay, so this is what I wanted to get at in today's video. As far as Dreamfolks goes, it has seen a lot of action in the last 5-6 months. Around June of this year, reports first circulated of major card issuers like ICICI, HDFC, and Axis cutting ties with Dreamfolks, which was followed by CRISIL putting the company in negative watch, which was then followed by some prominent launch operators parting ways. However, I think the first signs of weakness showed up a lot earlier, way back in August of 2023, when airport authorities increased CAM, that is the common area maintenance charges, by 3 times, which adversely affected margins in that quarter. In the same call, Ms. Kalath went on to add that what was a margin of 14-15% would move down to between 11 and 13% going forward. A 3% drop in margins is quite significant, but what this also explained us is how much of control that Dreamfolks has on its own business model, which I'm afraid to say is not much. A second problem, this time involving Adani, came in September of 2024 when an outage at Dreamfolks disrupted launch services at 7 domestic airports. Again, I have a feeling the Adani guys would not have taken this lightly. And then all through 2024, and in the early part of this year, many banks and credit card companies started cutting down on complimentary launch visits, linking it to a spend-based criteria rather than just offering it. So these are some hints, some clues that I could come across. I'll be lying if I say that it's very easy to even collect these, process this, analyze this, and to arrive at the right conclusion. It's not. It'll be an exaggeration for me to say that. But the point I want to put across, which I've been doing it for many videos now, is that the more you research, the more you study, the more mistakes you make, it becomes a lot easier to spot the patterns, and you'll see that your proportion of taking the right investing decision actually goes up by leaps and bounds. Uh, as far as Dreamfolks is concerned, they are now restarting things from scratch. So whether they will rise from the ashes and develop into a flourishing enterprise, there are no clues to say yes or no to that. But I'm hopeful that whatever we have discussed and learned in this video will help you at least look at platform businesses in a different light, and you'll be able to evaluate them a lot better now. Once again, here's a quick checklist based on what we have learned today. Please remember it, take a printout of it, and feel free to add more to it as more information comes to light. As always, I wish you the very best. I think there's still one more video to go before we end the year, so do watch out for that. And yeah, have a wonderful day, and I'll see you very soon. Bye bye.